Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, as well as Mike Khouw, CNBC contributor and YieldMax strategist at YieldMax ETFs. We're here to discuss tariffs, trade uncertainty, and rising volatility in a market that also continues to trade higher. It's great to have the both of you with us. As always, Brian, let's kick this off. Markets are up, VIX is up, vol is up. Is this a signal for the beginning to the end as trade and tariff risks start to get baked into the markets?
Yeah, I mean, look, if you look at past historical data, I've never liked it when I've seen markets up and then we see put buyers come into the market. That's one thing that we've been actually going on really back to early 2024, where anytime the market sort of rose, we've seen a higher degree level of put buyers come in on the downside. And when you look at skew and how a VIX is calculated, it's based off of option prices on the S&P 500, and as those put prices get elevated to some degree relative to where the calls are at, we see the VIX and volatility start to rise. So certainly we're starting to see that continual basis creep into these markets. It has a level of concern as if institutional traders that sort of push these prices along, that they're saying, I need a hedge in place here if the market is going to continue. Now, what can happen is, and what we have seen is the wall of worry can continue where people are allowed to now stay long the market. They have their protection in place and nobody's really willing to get out, and valuations continue to expand. I mean, obviously the tariff uncertainty raises levels of uncertainty in the market naturally. And so maybe that's why the VIX is going up. But we are seeing some levels of concern that both are rising together because they should move opposite to each other. But we have seen past historical markets where both can go up at the same time. And maybe we're just in this age of euphoria and AI technology.
Yeah, and of course, Brian, markets will do what they do until they don't anymore. But Mike, let's go back to valuation for a moment here. We have to address that elephant in the room. From a fundamental perspective, how are tariffs and supply chain shocks affecting growth expectations for tech and equities more broadly?
Yeah, it's interesting that if we think about how investors are viewing their expectations associated with tariffs, the impacts don't seem to be that big. What I mean by that is, and this is reflected in stock market price action. You know, as you see prices continue to rise, that essentially reflects that there is continued investor optimism about the future. And you know, just take a look at how we've done since the tariff tantrum, if we can call it that, the post-Liberation Day swoon that we had. You know, we're now considerably higher than we were before all of that. So when you look at it that way, it's not like there's a lot of concern baked into the cake. But, you know, the valuations overall are quite high, right? So if we take a look at the price to forward earnings estimates for the S&P or the Nasdaq, it doesn't matter. You take any of the sort of the large cap indices and you look at them historically, you know, we're at pretty high levels. You know, we've only seen these kinds of levels or higher a couple of times in my professional life, and Brian's too. We've been in the business for about comparable amount of time, but we're trading around 28 times forward earnings. I would ignore the multiples that you see following the pandemic because you had a lot of economic distress, so that brought earnings down. So that you kind of have to discard that data point. And the same thing during the GFC, because financials had such huge negative income numbers that it dragged down earnings for the S&P precipitously during that period. And so again, it's kind of a throwaway. So I like to look back towards, and I'm not trying to scare anybody by doing this, but I'm more inclined to look back at the 98, 99, 2000 period as kind of my benchmark for valuation, ignoring those idiosyncratic events associated with the GFC and the pandemic. And, you know, it's pretty much only that period in the modern era that we've seen valuations higher than the ones we have today. The one consolation I would give to investors, though, as we look at that, is that because we had that tariff swoon, we have to think about how regularly the market has these market corrections, so a decline of 10% or more, and actually formal bear markets, a decline of 20% peak to trough or more. I think the tariff tantrum, we didn't actually formally close in a bear market because we got that sharp rebound, but we had an intraday one. Brian may remember that better than I do. But I'm a little bit concerned about the valuations, and Brian's point's well taken. The other
Yeah.
parallel to that period I just talked about, 98, 99, and 2000, is that we had ever rising prices and volatility started to go up, not down, which is our normal expectation.
Yeah. So Brian, keeping those timeframes in mind, right? 98, 99, 2000 compared to today's Nasdaq, right? Given that backdrop, can volatility structurally reprice higher this time around?
I think it can. And Mike actually brings up a really good point, and this might be why volatility is on the rise while the market is still moving higher. Is that number PE, the price to earnings ratio, the valuation on companies, as that sort of elevates, people get a little bit more nervous about where the true valuation of this market is, and maybe that's a push or a concern of rising volatility, I should say. When you look at the VIX, I had a chart here, just looking at just August till now, we've seen sort of the Nasdaq continue to move higher and the VIX kind of make these higher lows, right? But then you look at the time period, and Mike brought this up, and so do you, like 98, 99, 2000. I would almost maybe structure it as a few years before that. Because certainly we obviously saw a huge spike in volatility when things sort of rolled over on the tech bubble. But prior to leading up to that, which we have very similar environments of where the Fed is and recently cutting rates as it did in 95 for the first time. And what you look at a chart here, the Nasdaq versus the VIX and volatility is, again, this slow grind of higher lows in the VIX, right? So the VIX really not coming down to levels, sort of like to your point, Jill, repricing of volatility to a higher level of extreme. And those spikes to the upside became even higher and higher as we moved on all the way into that 98 Russian debt crisis and all the distress we had around the bond market during that time. So maybe we're entering into that environment where sort of it's in this mid 90s, not so much late 90s, but mid 90s. We're going to get this repricing of volatility to a higher level, and we're going to get bigger and bigger swings. But at the same time, people needed to be invested. I mean, look at what the Nasdaq did over that 3 or 4 year time period.
Yeah. And so Mike, let's translate this into something actionable. If vol moves higher, which sectors can still sustain earnings and which ones do you think could get cut first?
I think staples can sustain earnings. I was actually just I was actually looking at some single stocks that about a year ago had performed pretty poorly. One of the things that we saw recently, so earlier this week, we got some consumer data that was a little bit concerning. I think we saw auto loan delinquencies at numbers that we haven't seen and my memory is failing me. It's only been 4 days since these numbers came out, but I think it was something in the neighborhood of 15%, 15 years or so since we saw auto loan delinquencies as bad as they are right now. And when you take a look at the stocks that were doing well and those that were doing poorly coming out of that, it's probably not surprising that inside of financials, for example, the BNPLs, the buy now, pay later companies like Affirm and so on, and the credit card companies that focus on the lower end of the demographic were doing poorly. So like Capital One. It's going to be very interesting to keep an eye on that because, of course, we're going to start seeing, not next week, but the week after, we're going to start getting earnings coming out of financials. If you want a forward look, see what they're doing with their loan loss reserves and basically, what they're essentially getting prepared to deal with on the credit side. But if you also take a look at what was going on the retail side, staples, were considerably outperforming discretionary. We also had some numbers, I think, that said that holiday spending is anticipated to come in about $130 a household shy this year of what they were last year. Now, whether that actually plays out is another matter. I think that, people have a tendency to, budget, and then they have a tendency to go over budget where holidays are concerned. So, I tend to discount that a little bit, but I think it's something to keep an eye on. I was looking at BJ Wholesale, for example, just as a single stock example. They get 70% of their revenues from groceries, similar to what a Costco does, more than what a Walmart does. And, when people are feeling financially strapped, they still buy their groceries, they still buy their toilet paper. And I think that if there's going to be a safe haven, it's probably going to be in those places. And those are companies that are, for example, BJ's, I think, is trading something like 19 times. So that's 19 times forward. So that's 8 or 9 turns cheaper than the S&P and less than half the multiple of a comp like Costco. So I think those are the types of places that'll probably be relatively safe havens. That and other staples areas are probably the things I would look to.
Yeah. Well, Mike, let's talk about big tech as well, right? Because we're starting to hear some of the ringing of the alarm in terms of the massive capital spending by big tech into AI infrastructure, whether it's for data centers, whether it's for energy infrastructure. Do you think that's enough to offset growth headwinds and lead the next leg up here?
Yeah, I mean, it's I don't see this is a business situation that it's difficult for the companies that are making these investments not to do it, right? Because if you listen to the comments that somebody like Mark Zuckerberg makes, he thinks this is existential, right? So he feels like if we don't make this investment, we are not going to be a part of the story in the future. And so, and those companies, it should be said, the hyperscalers, these are businesses that have the free cash flow to support that investment. So it's interesting that you have this we don't normally see this confluence of events where you have the highest flying companies are very likely going to continue to do what they do regardless of what comes next, because number one, they can afford it, and number two, they think they must do it. So when you think about the suppliers to those businesses, whether at a high level it's going to be the NVIDIAs and Broadcoms of the world, and secondarily you're wondering about whether AMD is going to be able to compete, or whether Intel, which is now getting some play, might actually get to participate for once in all the stuff that's going on. I kind of think that it's going to be like a barbell situation where you have these companies at the top that are protected by massive amounts of free cash flow, have moats around their businesses, are going to continue to do what they do because they feel like they need to and they can afford to. Then you have a whole bracket of companies that are actually trading well cheaper than the market, are usually safe havens in market turndowns. And kind of in the middle, what are you stuck with? You're going to be stuck with consumer discretionary names and things like that, which are going to be largely affected by consumer sentiment, among other things, and that's largely going to be driven by the labor market. You get labor market weakness, consumer sentiment and confidence drops, consumer discretionary spending drops. And that's going to take a big swath of that middle out. Why is that? Because 70% of the U.S. economy is consumer spending.
Yeah. So, Brian, if we take a look at it from the volatility perspective and how it's pricing in the AI infrastructure thematic, are you seeing vol rising for both the growth names that we typically look at in the tech space? And then also, what about the power and energy plays?
Yeah, it's really creeping into both areas of the world. And I think as you sort of like Mike alluded to, like this spread and barbell approach, as we sort of get that spreading out of who's going to be the winners, that's one reason for volatility to rise. Then you look at AI sort of driving it and those valuations, Bezos basically saying that AI is in this spending bubble. Bubble's kind of maybe the wrong word because people hear bubble and they think it's going to burst. I think it's a spending spree. And what he really meant was we have to spend now, like Mike said, with what Zuckerberg is saying, spend now to win later. And he believes that is going to take place. So that's one area creating some volatility. I think the other area is, in order to make this whole build out happen, is the energy infrastructure has to rise. I was just with some clients down in Indianapolis, and there was this whole fight about a new data center going in northern Indianapolis and how that would affect energy prices for regular consumers and whatnot. And so there will be this fight in the energy world is, can enough meet the demand of AI that is needed to build out? And again, if it does, we're going to have higher prices in some of these type sector names of the energy infrastructure play that will also induce some volatility, as that will be tied to some of these growth names. So you're seeing utility volatility increase. You're seeing AI, growthy kind of names, volatility increasing. That combined is just sort of lifting the market with the middle kind of left behind for right now.
Well, I'm going to add my 2 cents in here as well, and a little bit contra to that, but I don't think it's quite clear just how enterprise consumers of this type of technology being delivered by the AMDs and NVIDIAs of the world, exactly how they are going to use it at the end of the day. And if that ROI is understood at this point, perhaps it might be used in a different way. And I think that's one of the outliers, even with the big growth names that continue to carry the market. I do think that's something that investors should be aware of. That's just my 2 cents. But Brian, if we were to put a structured option or overlay play around all this, how would you lean into the Nasdaq 100 index here, which is home to virtually all of these hyperscalers?
Yeah, listen, I'm portfolio manager on a Nasdaq hedged equity fund, and when we look at things and structure of how to overlay, how to hedge, how to protect in case the valuations are too stretched, I like simply it's being long a call. If you're not familiar with option trading, I brought up a little graphic here on what a long call looks like. Basically, you outlay a little bit of premium, and that's all you risk, and then you get the upside participation to the call. Why is that? Because you have the right to buy, in this case, let's say the Nasdaq 100 at a certain price point, no matter how high it goes. So you get the upside participation, and you only risk sort of the premium. If we're going to sort of enter this level of regime of higher volatility, the premiums on these calls are going to kind of hang in there and not decay away in case we don't get through those strike prices. So as the market's sort of waiting to go, I would be looking at 3 to 6 month options, maybe going a little farther out, looking to buy a call, let's say on the Nasdaq 100, and looking for upside participation. If we get a volatility pop, there's some ways to use now selling a put, which is a whole nother subject, but you can sort of lower some of your cost and reduce the cost of the call by selling a put at that moment in time. But right now, I think if volatility rises and stays bid, I want to own a call rather than outright own the market right now.
Right. And Mike, to wrap this up here in a tiny, neat little bow, what's your fundamental thesis backing this trade or not?
Yeah, no, I think this makes good sense. It's one of the things when people look at options that they rarely consider, which is that you look at the price of an option and you consider how that obviously has to decay. The extrinsic value of that option has to decay to zero by the time that it expires. And usually, in most market conditions, what you have is what we call the volatility term structure is going to be upward sloping. That means that long-dated options have higher implied volatilities than the nearer-dated ones do. But I think the thing that Brian is looking to potentially play for is that the front end, the vol of vol, if we'll call it that, can be a lot more choppy. And if we get a spike in near-term options prices responding to the increases in volatility that we've seen, the value of that longer-dated option that Brian's alluding to can stay stable a lot longer than you might think. It's going to be supported by that uptick in volatility, even if it's not necessarily supported as much as you might hope by an increase in the value of the underlying assets. So, this is one of those dynamics where, the near-term volatilities have ticked up. If you think it's part of a broader trend and you're going to see ever higher increases in volatility through the end of this year and early into next year, you probably want to be long options rather than short them.
All right. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.